Let me start with this. There are very few companies in the world that quietly change how modern medicine works, and even fewer that end up shaping healthcare systems, insurance decisions, and global markets, all at the same time. Novo Nordisk is one of those companies. Novo Nordisk is a Danish pharmaceutical company that's been around for more than 100 years. But in the last few years, it's gone from being a relatively quiet healthcare name to one of the most important companies in the world. And that's not hype. Novo focuses on diabetes and obesity, two of the fastest-growing health problems on the planet. Their breakthrough drugs, Ozempic and Wegovy, belong to a class called GLP-1 therapies. And these drugs don't just treat symptoms. They change how the body regulates blood sugar and appetite. That's why you're seeing them everywhere. In doctors' offices, insurance discussions, government healthcare debates, and even pop culture. What makes Novo Nordisk so important is scale. We're talking about hundreds of millions of potential patients worldwide. And right now, only a small fraction of them are being treated. This isn't a short-term trend. This is a long-term shift in how chronic disease is managed. And Novo Nordisk sits right at the center of it. Now let's talk about valuation. But let's keep it simple. Novo Nordisk is already extremely profitable. They operate with very high profit margins, especially for a pharmaceutical company. That means for every dollar they bring in, a large portion turns into actual profit. Here's a simple way to think about it. Two companies can have the same revenue, but the one with better margins keeps more money at the end of the day. Novo is that company. Despite this, the stock has pulled back from its highs. Not because the business broke, but because expectations got too high, too fast. When growth slowed slightly, not stopped, just slowed, investor sentiment cooled off. Today, Novo trades at a lower price-to-earnings ratio than it did during peak hype, even though revenues are still growing, even though demand is still strong, even though cash flow is still massive. That disconnect between business strength and sentiment is often where opportunity shows up. It's like buying a great company on sale, not because it's broken, but because expectations reset. Now, everything we just talked about sounds good in theory, but let's put some actual numbers behind it. Because real financial data tells you whether a great story is also a great investment. First, earnings. Novo Nordisk is generating very strong profit margins, with net profit margins around 34 to 36%, meaning it keeps more than a third of its sales as profit after expenses. That's very high for a large healthcare company. Morningstar.com. Now let's talk about the price-to-earnings ratio, or PE ratio, one of the simplest ways investors gauge whether a stock is cheap or expensive. Right now, Novo's PE ratio is around 13 to 14 on a trailing basis, significantly below its own historical averages over the past few years. To put that in context, the average PE ratio across the broad pharmaceutical sector is nearer 29, meaning many companies trade at more than twice the valuation multiple that Novo currently does. Let's bring in a direct comparison. Eli Lilly, one of Novo's biggest competitors, especially in the GLP-1 obesity and diabetes market, often trades at a much higher valuation multiple. Forward-looking measures show Lilly's PE around mid-30s, compared to Novo's high teens to low 20s forward PE. When the market is willing to pay more than 30 times earnings for a growth pharma name like Lilly, but only around 20 times earnings or less for Novo, that's a signal worth paying attention to. Now let's talk dividends. Novo also pays a healthy dividend yield of roughly 3.6 to 3.9%, which is higher than many of its large pharma peers. For example, Eli Lilly's dividend yield is under 1%. What that tells you is Novo is not just a growth story, it's also returning cash to shareholders, which is rare in high-growth pharma segments. And speaking of earnings growth, Novo's EPS, earnings per share, has been rising consistently, and the company has maintained moderate payout ratios around 45 to 50% of earnings, meaning dividends are sustainable even as they continue to invest in growth. But here's another way to see value. When you compare Novo to the average big pharma name, like Pfizer, Merck, or Johnson & Johnson, these companies often trade at similar or even higher PE multiples, despite slower growth profiles. So Novo stands out because it combines high margins, growing earnings, A strong dividend yield lower valuation multiples than both the sector average and some direct competitors. Aversion to high valuation has pulled the stock down more than the business has actually weakened. And that's where the undervaluation argument comes in. In simple terms, you're paying less per dollar of earnings today than you were a few years ago, even as earnings continue to grow, and while the company still pays a solid dividend. That combination doesn't show up in every healthcare stock. It's one of the reasons some investors are calling Novo Nordisk a compelling valuation opportunity right now. So here we're looking at the Novo Nordisk chart on the weekly timeframe, which helps us see the bigger picture. Right away, we can identify two key levels. On the upside, there's a resistance zone around 56, and on the downside, a strong support area between roughly 44 and 46. If we zoom out, you can see Novo traded in a range for several years until around 2021. Then, starting in 2022, the stock made a strong move higher, driven by demand for GLP-1 drugs, which we talked about earlier. That rally peaked in 2024, and since then the price has pulled back significantly, returning to this long-term support area. What's important is that this decline is not because the company is unprofitable. Novo Nordisk continues to generate strong earnings. This looks more like a sentiment and valuation reset. Technically, the trend has been down, with lower highs and lower lows. But on the weekly chart, we're now seeing signs of a potential double bottom forming near support. Volume has also increased compared to normal trading levels, suggesting accumulation. If we switch to the daily chart, both tests of this support happened under oversold conditions, and we can see bullish divergence forming, which suggests selling pressure is weakening. Taken together, this structure often appears near major long-term bottoms. If the stock were to move back toward its previous all-time highs, from current levels around 50, that would imply roughly 180% upside. Because of this structure, this setup looks more like a long-term investment opportunity rather than a short-term trade. When you step back and look at the full picture, the bull case for Novo Nordisk is about what comes next, not just what it has already achieved. Ozempic and Wegovy changed how obesity and diabetes are treated. But Novo is not a one-drug company. Its pipeline includes next-generation therapies and oral GLP-1s, which could significantly expand global adoption. Strong margins, cash flow, and dividends give Novo the ability to invest in growth while rewarding shareholders. With valuation lower than peak hype and the stock near long-term support, fundamentals and technicals are starting to align. That's why many investors still see Novo as undervalued over a 5 to 10-year horizon. Risk disclaimer: this is not financial advice. Novo faces competition, pricing pressure, regulatory risk, and clinical uncertainty. Always do your own research.